wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets, and we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 222, and in this episode we're reviewing the performance of the financial markets during the 29th week of 2026, and that is from Monday the 20th to Friday the 24th of July. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where the Trump administration announced on Thursday that it will impose new tariffs on 60 countries over alleged forced labor violations. The tariffs, set between 10 and 12.5%, will effectively replace President Trump's temporary 10% global tariffs, which are set to expire at the same time as the new ones take effect. The forthcoming tariffs will apply to 60 trade partners and will cover over 99% of U.S. trade. The Office of the U.S. Trade Representative told CNBC that it could not provide an estimate of how much revenue the new tariffs will generate for the U.S. Treasury. Over to the Eurozone, where the European Central Bank voted on Thursday to leave its key policy rate unchanged at 2.25%, in a move that fell broadly in line with market expectations. However, traders are already anticipating a rate hike in September as ECB President Christine Lagarde warned that renewed hostilities in the Middle East and the resultant rebound in oil prices poses an upside risk to the outlook for Eurozone inflation. The European Central Bank said it stands ready to adjust interest rates to ensure that inflation stabilizes towards its 2% medium-term target rate. Meanwhile, Eurozone inflation eased to 2.8% in June, down from 3.2% in May. And in a press conference following the policy meeting, Lagarde said that the bank anticipates that inflation will remain well above target until the first half of 2027. She added that the longer that energy prices remain high, the more likely they are to drive up broader inflation through indirect and second-round effects. The hold in rates comes after the ECB raised its policy rate by 25 basis points in June as inflationary pressures caused by the energy shock due to the Iran war began to weigh down on Europe's economy. And over to the Far East, where data published on Friday showed that Japan's core inflation, which strips out the prices of fresh food, came in at 1.6% in June as higher oil prices began to spill over into the wider economy. This is the fastest rise in core inflation since March and was in line with the rate forecast by economists polled by Reuters. Headline inflation increased to 1.7% in June, up from 1.5% in May, while the so-called core inflation, which strips out both fresh food and energy prices, this dipped to 1.7%, which is the lowest rate since August 2022. On Wall Street this past week, the S&P 500 ended near flat on Friday, weighed down by chip stocks as investors assessed the latest developments regarding the Middle East conflict and as U.S. forces continued to strike Iranian targets over the past 2 weeks. Second quarter earnings season is off to a stronger than expected start, with corporate America delivering robust profit growth and widespread results that beat Wall Street's forecast. According to FactSet, of the 27% of S&P 500 companies that have reported results, 86% have topped earnings per share estimates and 80% have exceeded revenue expectations. Stocks had moved higher earlier in the session, while oil prices pulled back after Reuters reported that Pakistan was considering a path towards establishing new peace negotiations between the United States and Iran. The broad market S&P 500 added just 0.05% on Friday to close at 7,411, while the tech-heavy Nasdaq Composite dropped by 0.64% to end at 24,975, and the 30-stock Dow Jones Industrial Average gained by 235 points to settle at 51,947. In the government bond market, U.S. Treasury yields slid on Friday as oil prices dropped following a report that Pakistan, with China's support, was exploring a way to restart peace talks between the United States and Iran. The yield on the 2-year Treasury note, which closely tracks short-term Federal Reserve interest rate policy, pulled back by more than 2 basis points to close at 4.33%, and the yield on the 10-year Treasury bond, which is the key benchmark for mortgages, auto loans, and credit card debt, this had risen above 4.7% on Thursday but was down by more than 2 basis points on Friday before settling at 4.68%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, oil prices dropped on Friday on the basis of a report that Pakistan, with the support of China, was looking for a way to restart peace talks between the United States and Iran. Brent crude oil prices fell nearly 4% on Friday after rising over 7% to close above $100 in the previous session, after Iran-aligned Houthi rebels said they struck 2 Saudi oil tankers in the Red Sea. As fighting in the Middle East escalated sharply, the price of U.S. crude gained by about 8% this past week, and as Brent crude shot up by nearly 10%. Brent crude, the international benchmark, fell nearly 4% on Friday to close at $96.78 a barrel, whilst the U.S. benchmark, West Texas Intermediate crude, lost 3% on Friday to settle at $89.31 per barrel. In the precious metals market, the price of gold rose on Friday as Brent crude retreated from above $100, while investors assessed the latest developments in the Middle East conflict and their implications for inflation, especially ahead of the Fed's policy meeting this coming week. Bullion has fallen by about 23% since the war with Iran began in late February, pressured by expectations that oil-driven inflation could keep interest rates higher for longer. Investors now await the outcome of the U.S. Federal Reserve policy meeting next week, when it is largely expected to keep interest rates on hold. According to the CME's FedWatch tool, traders are pricing in about an 80% chance for a U.S. rate hike in September. While gold is seen as a hedge against inflation, higher interest rates typically tend to weigh down on the non-yielding metal. And in response to the foregoing, gold was up by more than 1% for the week. After falling about 2% in the previous session, spot gold was up by 0.3% on Friday to close at $4,060 per ounce. And a quick overview of the African financial markets. As South Africa's central bank surprised investors by keeping its main lending rate unchanged on Thursday, saying its current policy rate was restrictive enough to return inflation to its target rate within 2 years. That means that the central bank's policy rate stays put at 7%, with 4 committee members supporting the decision to keep rates on hold, while another 2 favored an increase of 25 basis points. Analysts say that the bank's tone was much less hawkish than expected after data showed that inflation in June had surged to its highest level in 2 years. The latest data shows inflation at 5% year-on-year in the month of June, which is currently 2 percentage points above the central bank's target rate of 3%. And moving over to the Kenyan financial market, we start by looking at the domestic foreign exchange market, where during the past week the Kenyan shilling took a slight dip but remained stuck within a very narrow range versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.53, and this is compared to a rate of 129.34 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.36 and the euro was valued at 148.04. And on the regional front, one Kenyan shilling was changing hands for 28.87 Ugandan shillings and 20.38 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.33. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by a massive $315 million for a grand total of $13.85 billion, which is equivalent to 5.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet the demand for overnight lending and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by central banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 14.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 23rd of July, and the central bank received bids totaling to 38.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 137%. The central bank accepted 29.2 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by more than 1 basis point to close at 8.78%, whilst the 182-day rate also fell by more than 1 basis point to settle at 8.95%, and the 364-day rate was a shade lower but remained broadly stable at 9.03%. Over the past few weeks, the Treasury yield curve now appears to be stabilizing, with interest rates clustering around the 9% level. However, there is still the possibility of higher interest rates driven by increased government borrowing as the Treasury seeks to plug a budget deficit of about 1.2 trillion shillings for the current fiscal year 2026-2027. In addition to that, the escalating conflict in the Middle East is once again pushing up oil prices, and as a result, we can expect inflationary pressures to pick up, and this will eventually feed into higher interest rates as the central bank endeavors to keep inflation expectations well anchored. As a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the impact of higher inflation. In the primary bond market, the auction for the two reopened fixed coupon Treasury bonds was held on Wednesday, the 22nd of July, and the central bank received bids totaling to 85.9 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of above 214%. The central bank ended up accepting 63.2 billion shillings and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2019 and now has 12.8 years left to maturity, the central bank accepted 12.2 billion shillings at a weighted average rate of 13.92% compared to the bond's coupon rate of 12.87%. And for the second bond, which is a 25-year bond that was initially issued in 2022 and now has 21.4 years left to maturity, the central bank accepted 51 billion shillings at a weighted average rate of 14.44% compared to the bond's coupon rate of 14.18%. At the Nairobi Securities Exchange, during the past week, the equities market was on an upward trajectory, with the NSE 10 gaining the most by 1.2%, whilst the NASI rose by just 0.8%. This takes the year-to-date performance to gains of 27.3% for the NSE 20 on the higher side, and by 24.6% for the NASI on the lower side. The weekly stock market performance was mainly driven by gains recorded by large-cap stocks such as East African Breweries, Diamond Trust Bank, and Kenya Commercial Bank, which increased by 7.3%, 3.1%, and 2.2% respectively. However, this performance was weighed down by losses recorded by other large-cap stocks such as Stanbic Bank, Absa Bank, and Standard Chartered Bank, which declined by 1.2%, 1% flat, and 0.8% respectively. Up next is our topical issue, and this week we're looking at the missing pillar in Kenya's sovereign wealth fund. Under the Sovereign Wealth Fund Act of 2026, all resource revenues are first deposited into a centralized holding account at the Central Bank of Kenya, and from there, the capital is partitioned into three distinct funds that are designed to achieve macroeconomic stability, domestic economic growth, and long-term generational wealth. The first of these three funds is the Stabilization Fund, whose primary purpose is to cushion the national budget and the broader economy against revenue volatility, external shocks, and sharp swings in commodity prices. The second is the Strategic Infrastructure Fund, whose primary purpose is to finance critical national development priorities and commercially viable public infrastructure projects. And the third is the Future Generation Fund, also known as the Urithi Fund, whose primary purpose is to preserve a dedicated portion of Kenya's finite natural resource wealth to promote intergenerational equity. While Kenya's Sovereign Wealth Fund Act is heavily modeled on Norway's Government Pension Fund Global, there are major differences in how the two operate. The missing pillar in Kenya's sovereign wealth framework is the lack of operational and institutional independence from the executive branch of government, and currently resembles a specialized treasury government account rather than an independent sovereign wealth fund. Case in point is the fact that the Treasury Cabinet Secretary sits directly on the governing board, blurring the line between policy oversight and day-to-day management of the fund. In addition to that, withdrawals from the Stabilization and Strategic Infrastructure Funds are governed by standard fiscal principles contained in the Public Finance Management Act, which is the same law administered by the Treasury. This is in sharp contrast to the Norwegian Fund, which has set a rigid long-term ceiling on withdrawals, And in Norway's fiscal rule, government withdrawals are strictly limited to the fund's expected real rate of return, which is historically capped at 3 to 4%, and this ensures that the principal wealth resource is never withdrawn. And without strict legal insulation, investment decisions risk alignment with short-term political pressures rather than the creation of long-term generational wealth. In summary, measured against the Norwegian Fund, Kenya's Sovereign Wealth Fund Act of 2026 resembles a specialized treasury government account rather than an independent sovereign wealth fund. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them posted on the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, all our dreams can come true if we have the courage to pursue them. A quote by Walt Disney. Think about it. Thank you, and God bless.